Welcome back to 5 charts and 5 charts only. Today we'll be focusing on the S&P 500 SMH Semiconductors ETF, the EWG Germany ETF, XLV Healthcare, and lastly, Bitcoin. So let's start with the S&P 500. And so as we know, it keeps going higher, and one of the achievements recently was that it hit our highest target yet of 67.45 just this past Friday. Now, of course, it's significant because it was our highest target and it was triggered here on May 12th, same time that the other pattern was also put in play. So that one, which was triggered right around this spot, was never retested. But this one at a higher price level it actually got undercut in the early stages after breaking out. And this was actually one of the biggest pullbacks, believe it or not, over the entire time, about 3.5% right at the end of May, which of course set the stage for one of the first real rounds of dip buying, and off we went from that perspective, right? It also marks the 5th upside target we have hit since the market low in April. So as we know, going back to 2023, 2024, one of the keys to that comeback that lasted for so long was having successful bullish patterns happen over and over again. In fact, we had 11 consecutive bullish pattern targets hit. As we know, that just means we got breakouts. Those breakouts were clean. The breakout zones were not tested. That eventually helped those upside targets get hit. And then really we just did the same thing over and over again. And that is, of course, a recipe for how uptrends are made and can live on, right? And so this is another example of that. It took a while to get there, but that's no problem at all. Usually what happens is you have an intense amount of volatility to set up the bullish pattern. It breaks out, sometimes emphatically, sometimes not, but eventually getting there will take some time. And by that point, the market typically morphs into a more consistent, calmer uptrend, which of course has been the case now for many months. Now, that means, guess what? There are no bullish pattern targets in place, or bearish pattern for that matter. Last time we had a bearish pattern play out was that nasty bearish flag, as you recall, happened right in the middle of March, right before the bottom fell out. As we talked about that day, the silver lining was there are no more bearish patterns in play. So that means it was a jump ball for the next pattern to form. So guess what? Similar thing now. Now, there are many ways to get price targets, 5-0 extensions, among many others, but we based our analysis on the bullish patterns because good to see a foundation and we understand the mechanics behind having that target in place, what needs to happen for those breakout zones not to be violated. It's very important. But along the way, we're going to identify some smaller ones. And recently, this is a 2-hour time frame. We've seen that there's some good breakouts here in September, and again, most recently at the end of September into early October. Now, we're not going to put all of these on the pattern grid because we can really drill down and see, of course, bullish patterns form across really any time frame, but if they're within, say, 1 or 2% of a breakout zone, you have a tendency to get more and more whipsawed. And so that's important to realize, but also judging how these smaller versions play out, you obviously want to see more of them be successful than not, and that will keep the foundation in play and keep the hope alive that bigger versions can eventually be constructed without there being too much damage along the way. And so another way of looking at this in terms of patterns is just these trading boxes. We talked about this before. It's a very simple process. And again, we don't have to be a big expert on classical formations from a technical analysis standpoint. If you understand how to draw boxes around trading ranges, then you have this strategy nailed. And along the way, as we can tell, because of how consistent things have been, every time there's been a pause, there's been an upside resolution or a breakout, which then gets us higher. And, it hasn't been exciting by any means, but at the same point, this is how dip buying works. You get us to the next level, consolidation again, and off we go. So what we want to look for here is always when things change or when the character looks less like a bull market and more like a bear market. And one indication of that, the very first step will be seeing one of these consolidation zones eventually resolved to the downside. Now, as we know, that will not give us an idea if that is the top or just a local top or a short-term one, but we know that's coming again at some point. So we're going to continue to track these and showcase these hopefully showing the times when that is going to happen next. And so this has been a really helpful tool going all the way back to 2023. So this is, as we know, very close to the low in 2022. And along the way, all we have to do here is identify how many blue boxes there are versus red boxes. Many blue, that means we're in an uptrend. A lot of red, downtrend. So along the way, we know there's been some corrections every so often. And the one that really was different than any other was what took place from just after the election into February, where there was a lot of false moves. And remember, we're talking about at the time, we found it very difficult to classify any of those smaller ranges as really useful trading boxes because there was a lot of whipsaw. We had to extend that box horizontally and vertically to really capture what was going on. And eventually, we know that led to a big move to the downside, but a big move nonetheless. So it always makes sense to pay attention to how these trading ranges play out. So all that being said, we like looking at the short-term price action because it gives us an indication of a trend change. But the biggest trend, right, continues to be higher. And we've sometimes shown this chart in the past, and it just looks at all the price action, as we can tell here, going back to 2013. And we try to just pinpoint the major trends, right? Of course, blue being higher, red being lower. And so it just takes a lot of this noise out along the way. And what this shows us now, 2025, two things. Number one, downturn or the crash, 2-month tariff tantrum, looks just like a small red arrow. As we know, basically straight down, very similar to COVID, but not even close in terms of getting the magnitude of the decline here. And if you look at this as one big uptrend, this looks like a normal dip that investors have bought, and now we're making new highs. Now, in terms of the rally, we know the S&P 500 is now up nearly 40% from the lows, so a substantial move. But, compared to some of these longest uptrends that lasted for multiple years, it's still smaller than the other ones. Could this be one of the shortest ones and the market could crash right after this? Sure, of course. But let's look at this from a very big picture point of view. Going back the last 12 or 13 years, we've seen bullish phases last longer, right? So again, that just means going forward, we're going to see digestive phases, and they're going to be just set up for the next round of bullish patterns to form. And if that changes, of course, we'll talk about that as well. Okay, moving on to SMH Semiconductor ETF. Now, this is after the big move from A&D triggered just another strong advance for the SMH. But as we can tell, it's the same scenario, right? It's been a series of strong breakouts, but more so consolidation periods that are resolved higher. So the same thing with this, especially with SMH being a leader both within technology and the market in general. If one of these trading boxes turns red, it could tell us that the SMH is due for a greater pullback as well. Now, along the way, it's done great. We identified this bullish pattern on the way up here in May, June, broke out, and never looked back, even though we had a pause in the summer months, and then just recently hit that 330 target. So it doesn't mean that the entire trend is over, but this particular trade, did what it needed to do, hit the target. So at that point, just like the S&P 500, is earned the right to at least digest some of this move, to the point where the most recent move got the RSI, the 14-day RSI, to above 82. And as we can tell here, just a few days ago, it hit 83.11, which, judging by all this action going back to 2014, was the second highest of them all, with the other one being in the late 2017. So needless to say, these all happened in strong markets. Some of them came very close to marking key tops. This was in the summer of 2024. Market rolled over soon after that. Last one was in late 2021. We know what happened after that as well. But sometimes something like this triggers after a big move with much more to go. And that was the case here in the middle of 2019. It got pretty extended, sharp pullback that lasted just a few weeks. But then, of course, a major bid came back into the system, and that lasted right before COVID for the most part. EWG Germany, and this is one we look at quite often just because Germany has such an influence from economic level and from a stock market perspective too in Europe. But Germany really hasn't done much, has flatlined really since the beginning of May here. Made some marginal new highs over the summertime, but really hasn't gotten back up there. Now, again, this is a weekly perspective. We can tell that along the way, it has undergone a similar chain of events before breaking out. But considering so many other areas are just continuing to make new highs, it's pretty clear that Germany has lagged. And the thing is, it was due, right? We talked about how this coming into the early stage of 2025 had pushed the relative line, right? EWG versus S&P 500, the weekly RSI, to levels really we hadn't seen before. This is going all the way back to 2000, right? This was in the 75 zone for a number of weeks in a row, and just showing that even if this was going to be a major turn higher, it didn't seem like that type of outperformance was going to last, which of course it hasn't. And as a result, the relative strength line versus the S&P has turned lower, and the RSI itself has dropped all the way down to at the low around the mid 30s, right? And so it's important right now then, if this is really going to be, Europe's time, especially Germany being one of the leaders there, you would think that this could then set the stage for a higher low to develop after, again, not doing much. So that could mean that the S&P could eventually pause and EWG Germany could eventually break out. That would be something we'd be watching, because the last few times that RSI got into the mid 70s was back here when Germany did very well and actually outperformed the S&P 500 for years, right? This is the low in early 2023, and that extended all the way up until toward the end of 2007, right before the great financial crisis, right? So we had multiple times when the outperformance was strong enough to trigger overbought readings on a weekly basis versus the S&P 500 here. But one key factor to note here is that along the way, the RSI did not touch oversold levels, again, from mid-2023 all the way until middle of 2008. So if this is going to replicate that type of action where we're due for many more years of European and Germany outperformance, then you want to see this RSI again avoid hitting oversold levels. And so a key, of course, is going to be what the US dollar does. As we know, Germany, EWG, is priced in US dollars. So when the local or ordinary index moves higher and the US dollar moves lower, that's when EWG and all the other ones do so much better. It gets an extra kicker there. So at the same time, if we do fact finally see some sort of bounce in the US dollar, you would think that then Germany would roll over as it did previous times emphatically, 2018, 2021. The higher that EWG goes and the lower that dollar goes, right, that rubber band's going to get stretched. And when it finally snaps back, you may see big moves in the opposite directions for both of these. And so if nothing else, right, if you don't feel like trading EWG, if you don't pay attention to Germany, I think maybe we all should, just to get an indication of how this is reacting, if in fact we do see some sort of change of character, both in the dollar and maybe in US equities as well. So if you like this kind of content, again, I urge you to check out our Substack newsletter, Cap Notes, where we go much more into detail to all these topics. We put on videos like this, other videos that we do for stock charts, TV, and also showcase many unlocked full reports, which includes chart trades, the stocks that we recommend with both entry points, exit levels, both on a target price and stop loss. So again, you can get that at capnotes.substack.com. See you there. Okay, let's turn to XLV Healthcare. As you know, had a huge week last week to the point where it was one of the strongest we've seen in years. And what that did technically was finally break through this resistance area in the high 130s and trigger this double bottom-like formation. As you can tell, that would have a target up near 150. And that's key because that was a 2025 high. And coincidence or not, this is happening around the same price levels as the last time we had a substantial double bottom breakout as well, which was just the end of 2023. And that eventually led to a pretty substantial rally culminating with the high in the summertime of 2024. So as you can see here, it's had a rough time along the way. Let's not forget the rough time that it had before that, where it didn't really get hit that hard, but it was moving sideways for over a year before finally leveraged this type of move. So this is a good blueprint of which to follow. And one reason why we think it can eventually get there, two reasons. Number one, it also bounced near this very key uptrend line, right? Extending from the great financial crisis low in early 2029 and early 2009. The COVID crash also hit that line, with XLV bouncing obviously very strongly from then. And then most recently, once more. And that also happened in close proximity to very key support that was in place from 2021, 22, and 23. So all this at the time, and we talked about it in various reports to our clients, was that the risk reward from a long-term basis seemed to be in favor of XLV bouncing. As we know, it didn't happen right away, and there are a lot of whipsaws until it got there, but it didn't get much worse, right? And that was key to eventually seeing this type of move. Secondly, we're coming off the most oversold reading of the XLV versus the S&P 500 on a monthly basis in its history. You see how this looks here. And so, again, that was one reason to expect a bounce. So we got the bounce, but as we can tell here, it has a lot more way to go, potentially so both on an absolute basis and relative basis. And we think that this line could move much higher from there. Okay, lastly, Bitcoin. We know that crypto overall has had a strong comeback over the last week and a half or so. And today, Tuesday, October 7th, we're seeing the first real pullback. And so let's review why it's pulling back. Number one, it was a really strong move, got above the most recent all-time highs, but not that much, right? We've seen fake outs before going back to the summertime. It also produced the first overbought reading officially since the middle of July, happened here, and Bitcoin pulled back. And also, the 9-day rate of change, so it was up 8 of 9 days, and across those 9 days, it was up about 13%. And believe it or not, that was the biggest 9-day advance. This is what we saw right after the presidential election in the U.S. in November of last year. So all that suggested that eventually we'd see a pause, right? That pause is coming. As we can tell here, though, if that eventually gets bought once more, say a good spot will be above this point here, which is 117, this could be another higher low, which combined with the action from July could end up forming the right shoulder of an inverse head and shoulders pattern, which of course would give us another upside target to shoot from. As of right now, the one that's in play continues to be 142,000. That's been in play, since June, and it's been tested numerous times, held numerous times, but still needs that extra round of demand to finally get us to that point. And so one of the reasons why, of course, this seems like the time to do it is from a seasonality perspective. I think anyone who traffics in crypto knows that the fourth quarter in Bitcoin's history, especially October, has been very positive from a seasonality standpoint. Bitcoin has been up 9 of the last 10 Octobers going back to 2015. So it's not surprising that the last 2 also saw strong moves that coincided with breakouts from very key substantial bullish patterns. And as we know, those breakouts gave us extremely strong moves above prior highs, right? 130% or so advance from 2023 to early 2024, a 50% very quick advance into early 2025 as well. And so we're above that breakout zone now, but still waiting for that next really big push. And again, with it potentially happening in October, where we've seen strong moves before, this is the time to do it. Don't forget to check out the other 5 chart videos we have here. These 2 are a great place to start.